Hey there, fabulous financiers. Welcome back to the Do.Different.Better Show, where we talk about wealth, wisdom, and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, founder and CEO of Social Impact Now, Connective Institute, and managing director of the Integrated Capital Fund. Thank you for joining me today. In our last episode, I covered the basics of the stock market, what stocks are, how the stock market functions, and gave you an overview of some of the major stock exchanges like the New York Stock Exchange and NASDAQ. I also talked about why investing in stocks can be a great way to grow wealth over time, plus gave you some practical tips on setting financial goals, opening a brokerage account, and regularly reviewing your portfolio and adjusting your strategy as needed, and gave you some great resources on books and websites just to keep you up to date and informed. So, while we talked about stocks last week, we're going to talk about bonds this week, the unsung heroes of the investment world. If you're looking to earn steady income and preserve your capital, this episode is a must listen. I'm going to break down what bonds are, how they work. You'll discover how bonds can provide a really great steady income and preserve your capital while also diversifying your investment portfolio. I'll compare bonds to stocks and explain why bonds are a safe haven during market volatility. I'll also guide you through the process of buying bonds, whether through a broker, mutual fund, or ETFs. We learned about those in the last episode. Plus, give practical tips on researching bond ratings, understanding bond duration, and staying on top of interest rate trends. So let's get to it. Let's just try to understand what is a bond. Bonds are a fantastic way to earn steady income and preserve your capital or your money. You'll hear me use money, capital, funds, all kind of interchangeably. Whether you're new to investing or once again looking to diversify your portfolio, this is going to be some really great information for you. So, what exactly are bonds? Bonds are, in the simplest terms, they're loans. They're loans that are given to an entity. Maybe oftentimes you hear about bonds as it relates to a government, a municipality, or a corporation. A lot of times you might have heard, hey, there's a school bond, and the school bond is to be able to build a new add-on to a public school campus. Colleges sometimes will use bonds to build new buildings, especially if they weren't able to raise the funds through private donors. But in exchange for regular interest payments and the return of the bond's face value when it matures, that's what you are getting when you are buying a bond. So think of it as you becoming the bank and lending money to these entities. And it's a little bit bigger than that. It's a collection of yous that have come together that have said, we're going to loan this money, which is why you often see this with municipalities, cities, townships, but also the federal government might issue bonds, right? In return for this money, they're going to pay you interest on a regular basis. And that basis is determined by the agreement of that particular bond. And they're all a little bit different, right? So, but here's a more specific definition. A bond is a fixed income instrument. Remember, we talked about asset classes and the fixed income asset class. It's a fixed income instrument that represents a loan made by an investor to a borrower. This borrower can be the government, a municipality, or a corporation. When you buy a bond, you're lending money to the user for a specific period of time. So, for example, if you buy a $1,000 bond and it has a 5% annual interest rate, the issuer, meaning the person who's borrowing the money, will pay you $50 every year until the bond matures. When the bond matures, you will get $1,000 back, right? So let's say that $1,000 bond is a 5-year or a 10-year bond. So for each one of those 5 years or 10 years, you're going to get that $50. And then at the end of the 5 years or the 10 years, you're going to get the $1,000 back, right? So, this is really, really valuable and helpful when you think about what is it the best way for you to just have some long-term sustainability with understanding, with getting capital back or making an investment into bonds. Now, there are different kinds of bonds. each bond has its own types of characteristics, right? There are government bonds. Government bonds are issued by national governments. So in our case, the US Treasury bonds are a common example that you may have heard. I don't know how popular they are right now, but when I was a kid, that was a common gift that grandparents bought for their grandchildren was a treasury bond, right? They're considered to be very safe because they are backed by the government, and we don't anticipate our government to fall, do we? Municipal bonds are issued by states, cities, or local governments to fund public projects like schools or highways. They often offer tax-free interest payments, meaning that in that example that I gave earlier, that $50 that you're going to get every year, unlike when we talked about capital gains from when you sold stock, you're not paying taxes on this particular $50 that you're going to get in interest payments. Then there are corporate bonds. Corporate bonds are issued by companies to raise capital for business activities. They typically offer higher interest rates, but can come with higher risk compared to government bonds. Just think about that. A company can go out of business. We don't anticipate our government going away anytime soon, at least not easily, right? Understanding these basics is really going to be key to knowing how bonds can fit into your investment strategy. So oftentimes you'll hear people say stocks and bonds, but they're not the same thing, but they can be used together to build a portfolio that is diverse or diversified. So now let's talk about how bonds actually work. When you buy a bond, you're lending money to the issuer, whether it's a corporation, a government, or municipality. In return, you're going to get an interest payment known as a coupon payment until the bond matures or when the bond is scheduled to end, right? So let's break this down. Coupon payments are the regular interest payments made to the person who's holding the bond or a bond holder, which would be you. They provide a steady stream of income, which is one of the primary benefits of investing in bonds. So once again, using our example, if you have a bond that has a face value of $1,000 and a coupon rate of 5%, you'll receive $50 in interest payments every year. So while we're only using the example of 1,000, what would it look like if you had $5,000 in bonds, or $10,000 in bonds, or $20,000 in bonds, or $100,000 in bonds? Hopefully you can start to take that $50 for every $1,000 you have, and that's a pretty nice sizable check. That could be the down payment for a house over time, right? So once again, going back to building a strategy like we talked about in stock market investing, you could also have a bond investing strategy of like, I'm going to hold this bond. This bond is going to be held for 20 years. If I buy it for my kid when they're 10, they're going to have this bond payout when it's 30. They'll be able to have a down payment for their house when they turn 30. So once again, this is how you want to think about leveraging the present to the future when you think about an investing strategy. The next part of a bond is maturity. Maturity refers to the end of the bond's term. At this point, the issuer repays the bond's face value to the bondholder. So in addition to those coupon payments that you received every year, now you're going to get the original amount of money that you put in, that you bought the bond with. So if it's $1,000, you're going to get $1,000 plus all of those $50 payments. But once again, think about this. At the end of maturity rate, you've got all of those coupon payments that maybe you've been putting into a bank account for your child or your grandchild, but now you're also going to get the $20,000 or $10,000 or $100,000 that you put into the bond. You're going to get that back in, let's say, using our example, 5 or 10 years, right? So there's typically not a limit on how many bonds that you can buy, depending on what kind of bond it is. The restrictions will be outlined to you for that particular bond, so you definitely want to read the fine print. So once again, if you bought a bond for a 10-year bond, you'll receive interest payments for 10 years. When that bond matures, you will get your initial investment back, right? So these regular investment payments and the return of your principal at the maturity of the bonds really make them a reliable investment for those seeking steady income and preserving capital, especially for long-range planning. But like any investment, bonds come with their own sets of risks. So let's explore what those are and how you can gauge them. Just like an investment, bonds come with risk. Bond ratings help you understand the credit worthiness of an issuer. So for individuals, we have FICO scores or credit scores. Bonds also have credit worthiness or credit scores. So let's dive into what those ratings mean and types of risks you should be aware of. So first, there's bond ratings. Bond ratings are provided by the credit rating agencies like Standard & Poor's, Moody's, and Fitch. These are all organizations that this is what they do. These ratings assess the issuer's ability to repay the bond's principal and interest. So, for example, there are the most common rating that you'll hear about are AAA, which is the highest quality, all the way to D, which means that they're in default. But here's a quick breakdown. AAA, highest quality, lowest risk. AA or A are high quality, very low risk. Then there's triple Bs. They're medium grade, medium risk, which is also kind of considered investment grade, like what you would put in the stock market. And then there's double Bs and below. These are often higher risk and sometimes referred to as junk bonds. You may have heard that was a big term in the 80s. People were trading junk bonds. That's what they were talking about. The second thing is risk. Bonds are generally safer than stocks, but they are not risk-free. Here are the main risks associated with bonds. Interest rate risk. Bond prices and interest rates move in the opposite direction. So as interest prices rise, bond prices fall and vice versa. This can impact the value of your bond, right, that you're carrying, especially if you're carrying, thousands of dollars within a bond. Then there's credit risk. The risk that the bond issuer may default on their payments. This will have lower rated bonds have higher credit risk. Now, once again, when we're talking about those issued by the federal government, maybe there's less of a concern. But if it's a corporate bond, you do have to worry about, obsolescence of whatever their product or service is, the downturn in the market, inflation, recession, if there's some kind of catastrophic event, meaning their main manufacturing is devastated by a hurricane, right? These are all things if a corporation has a bond out, that will impact their ability to repay you at the maturity point. So once again, inflation is really a big part of that. It can erode the purchasing power of the interest payments that you receive. So understanding these risks and ratings can help you make more informed decisions when investing in bonds. And by choosing bonds with appropriate ratings and being aware of these risks, you can build a portfolio that aligns with your financial goals. So that's it for this segment on bonds. We've covered what bonds are, how bonds work, and the different types of bonds that are available. In the next segment, we're going to dive into why investing in bonds can be a really great way to grow steady wealth and really how to get started. So stay tuned, come back and join us in the next segment, and I'll show you how to do different better. Hey there, beautiful people. Welcome back to the Do.Different.Better Show. I'm your host, Elaine Rasmussen. And if you're just joining us, and our last segment, we covered the basics of bonds. We covered what bonds are, how they work, the different kinds of bonds. And in this segment, we're going to dive into the benefits of investing in bonds. Whether you're looking for steady income, you're looking to preserve your capital or build a diversification strategy in your investing portfolio, bonds can be a really great addition to your portfolio. So let's get to it. One of the biggest benefits to bonds is really the steady income that they provide through regular interest payments. This is often referred to as the bond's coupon payments. So let's break it down. One is steady income, the steady income. Bonds really provide reliable source of income because they pay interest at regular intervals, usually semi-annually or annually. And this can be really beneficial for retirees or anyone looking for a consistent income stream, especially if you know that maybe you are going to be out of work for a period of time, whether by choice or by circumstance. Maybe if you are going to have to take on some long-term caretaking responsibilities, this is a great way for you to think about how can I have some regular income coming in to augment some of the other investments that I have. But also just as a safety net for your investments, if your investment tanks, you've got this other source of income in your investment portfolio. So for example, let's say you purchase a government bond. The face value is $1,000. The coupon rate is 5%. We're just going to keep using the same example. This means you're going to receive a $50 in interest each year compared to stocks. Now, obviously, $50 is not a livable wage, right? The whole idea is just to give you an example. As you incrementally increase the amount you have invested in bonds, obviously that amount is going to go up. And if you're going to have a higher coupon rate, right, in a shorter maturity time, that also could be very good for you, right? So just think about, I'm just giving you a concrete example that's easy to wrap your head around, right? $1,000, 5%, easy math. But compared to stocks, these are great because stocks can be really volatile and the dividends can be fluctuate, or they can be cut, or they can decide not to give out any dividends at all because the company is trying to do, or the organization is trying to do some massive overhaul or product addition or manufacturing addition. So what's really nice about bonds is it's a lot more predictable. The steady income is one of the primary reasons why investors include bonds in their portfolio, especially when they need some kind of income stream. Now, anybody who's relying on their bond coupon payments as income stream, we're talking about people who are probably investing hundreds, if not millions of dollars, right? But once again, remember we talked about compounding interest and compounding payments. So once again, while you may be 20 years old and starting your bond strategy, think about when you get to 50, right? Now that over time is going to be a pretty substantive amount of money that you can leverage. Once again, you might have enough to buy a home. You might have enough to buy a new car. You may have enough to travel the world for a year, right? But these are all the things that you can consider doing. The next thing is really around capital preservation. Bonds are a great way to preserve your capital, especially in uncertain market conditions. When you invest in a bond, you're essentially lending money to an issuer, and in return, you're going to get the principal amount when the bond matures. So thinking about capital preservation, bonds are considered safer than stocks because you're going to get that money back. So imagine if you invest $10,000. If you put all that money into the stock market, the value could fluctuate significantly based on market conditions, right? However, if you invest in bonds, you're more likely to see steady returns and get 100% of that principal back at the time of maturity. This stability can be particularly reassuring during down market turns. Well, while no investment is risk-free entirely, bonds do offer a level of security that can help protect your investment from significant losses. Now, let's discuss how bonds can diversify your portfolio. Including bonds in your investment portfolio can really help diversify your investments and reduce your overall risk exposure. Diversification means spreading your investments across different asset classes to balance risk and return. Think about it as a Las Vegas buffet, right? So when you're going to the buffet, you don't want to just necessarily hang out at one particular part of the buffet. I don't know about you, but I like to look at everything first. I might even do a couple of laps just to make sure, so I can be like, how hungry am I? What parts am I going to do? What flavors do I want? And then I start to build my plate. Well, your investment portfolio kind of works the same way. You kind of want to look around, see what's available, and that's why you're listening to this show. And then, based on what you've learned and what you've heard and what your goals are and what your strategy is, and short-term and long-term, you're like, these are the things that I want to put on my plate as far as building an investment portfolio, right? So I love the buffet analogy, right? Diversifying your including bonds in your portfolio lets you offset the volatility of stocks. Bonds often move so much differently than stocks. So when stock prices fall, bond prices can usually rise and they remain stable, which helps balance the losses that you experience in your stock portfolio. So let's say you have a portfolio that's 100% invested in stocks. If the stock market takes a hit, your entire portfolio suffers. However, if you have a mix of 60% stocks and 40% bonds, the stability of the bonds can help cushion the blow during market downturns, right? So going back to when we talked about, are you aggressive or are you conservative? A 60-40 split is kind of somebody who represents somebody who's in the middle. They really want a balanced portfolio. They're hoping to get some of the gains from investments in the stock market, but they're also want to hedge their bets and have these bonds to be able to weather the storms of any of the big ups and downs of the stock market. But diversifying with bonds not only helps manage the risk, but can also improve your portfolio's performance over time by providing a really stable foundation. This is particularly important for long-term investors who want to have balanced growth and stability. So that's it for this segment on the benefits of investing in bonds. We've covered how bonds provide steady income and preserve capital and diversify your portfolio. In the next segment, we're going to explore how to get started with bond investing and get practical tips on how to succeed. So stay tuned and I'll show you how to do different better. Hey, beautiful people, welcome back to the Do Different Better Show. I'm your host, Elaine Rasmussen. We've just wrapped up talking about how bonds are a great investment tool to provide steady income, to preserve capital, and to diversify your portfolio, particularly in your portfolio. It already includes stock, already includes real estate, or maybe some other opportunities. It allows you to have an instrument that allows you to weather some of the ups and downs of some of the other investment asset classes. And you'll remember we talked about asset classes in a different episode. So go back and take a listen to that. In this segment, we're really going to dive into how to get started in bond investing. We're going to cover the various ways to buy bonds. We'll talk about some practical tips, and we'll wrap up with some call to action and some great resources for you to get into. So let's get started. So first, how do you buy bonds? Well, there are several ways to buy bonds. Each type offers its own benefits and levels of accessibility, but let's break down some of the common ones, right? The first thing is buying bonds through brokerage accounts. And that is pretty much the most direct way to buy individual bonds, right? And here's one way that you can do this. So opening a brokerage account. We talked about opening brokerage accounts for yourself in the stock investment show, which was just immediately before this one. So there's E-Trade, there's Schwab, there's Fidelity. They're very similar to opening a bank account. You're going to do it all online. It's going to ask you for some personal information. It's going to ask you for your financial information. It's going to ask you for your banking information. So don't be surprised. That is how you're going to fund the account. You're going to take money from your bank account or whatever account you're going to use. And then that money is going to go, and that is what you're going to use to buy and trade on the brokerage account. The next thing is you would need to fund the account. So you need to transfer money from the brokerage account into the from your bank account into the brokerage account so you can start making purchases, right? The other thing that you want to do is you want to use the brokerage, the tools on the brokerage account to research and select the bonds you want to buy. And there are so many options. We only talked about 3, and there's lots of new exciting ones that are coming up. But definitely you want to pay attention to the bonds rating, the coupon rate, the maturity date, and the price, right? So there's some really interesting bonds that have kind of surfaced. There are what are called pay for success bonds. And pay for success bonds are, once again, these are usually issued by an organization, sometimes by a nonprofit, sometimes by a municipality or some other quasi-government related organization. And what it's saying is that we are going to pay this money that we're borrowing to this organization based on their success. So an organization A might be borrowing, let's just make it easy, $100,000, and they've issued pay for success bonds. They've borrowed the money, but they won't receive any of the money until they demonstrate some success markers that they have indicated that they are committed to reaching in the paperwork of the bond that they've issued, right? So just like a car loan, the car loan outlines the terms and conditions of borrowing the money to pay for this car. Bonds are very much the same way. A bond will outline these are the things that are required on both of the parties to be able to demonstrate before payments are made. So a pay for success bond, and it will outline these metrics have to be met before this money is paid out, right? Or there are consequences if the money is paid out in advance if they don't meet these success metrics or markers, right? Some other bonds that are kind of up and coming are impact bonds or social impact bonds. These are bonds that are correlated to some sort of positive social or environmental impact, meaning that we're borrowing this money to do some kind of activity that's going to have some positive social impact. And so that is the attraction for somebody wanting to put their money into that kind of bond versus a corporation bond, or maybe even a municipality or government bond. They want this bond because it's place-based, it's in their community, maybe it has related to something that is important to them, maybe like reproductive rights or anything like that. But those social impact bonds are also a new type of bond that you're seeing out on the market that are available. But once again, do your research, whether that's through the brokerage account that you have, and they'll have resources that are there for you. Going to the library, we talked about the research librarian being able to tell you what resources the library has for you to research more information about bonds or different kinds of bonds or doing research on the organizations that are issuing the bonds. Lots of great information that might be available free through your local library. So making sure that you, once again, pay attention to, if you're going to be buying a bond on a platform, that you're looking at the rating, right? We talked about that's like the credit rating, the coupon rate, which is the percentage that they're going to be paying you every year, the maturity date, when you're going to get your repayment of the principal, and the cost of that bond, whether it's $100, $500, $1,000, $10,000, $20,000, whatever that number is. And then the last step is to purchase the bond. Once you've found a bond that fits your criteria, you can place an order through the brokerage account, and you can usually buy bonds in $1,000 increments, right? So the other thing about that is you can buy several, going back to our stock analogy, when we talked about stock investments, you can buy multiples of one type of bond, or you can buy a little of many bonds, right? So you can use the same strategy that we talked about when investing in the stock market and apply it to bonds. So you can buy, if you've got $10,000, maybe you buy 10 $1,000 increments in a bond, or you can say, I'm going to purchase 10 bonds because they all have different rates and different ratings and different maturity, and I'm going to spend $1,000 on each one of these 10 bonds. Either way, once again, this is why it's important for you to have a clear understanding of what's your goal, why are you doing this, what is the return that you're looking for, so that when you make the choice of what you're going to purchase, that you have a really good sense that what you're purchasing is actually going to be in alignment with your goals that you're actually trying to achieve. So we talked about the first way is to do a brokerage account. The second way is by doing bond funds or ETFs, right? If you prefer a more hands-off approach, sometimes you'll hear the word passive investor. You can invest in bonds through mutual funds or exchange traded funds, or ETFs. You hear a lot of commercials say ETFs, ETF, and many of you might know ETF as electronic transfer of funds. This is not that. This is exchange traded funds, are exactly what the name implies. They are funds that are traded on exchanges or platforms, generally tracking a specific index. We talked about indexes when we talked about the stock market. When you invest in an ETF, you get a bundle of assets or a bundle of bonds that you can buy and sell during market hours, right? Market is open 6 to, I think, 2 or 3. This will potentially lower your risk and exposure while helping to diversify your portfolio. So let's talk about bond mutual funds. Bond mutual funds are managed by professionals. These funds invest in a variety of bonds to achieve a specific investment objective. They can be a good option if you want a broad exposure to the bond market without selecting individual bonds. Once again, this is a great way if you're like, I don't even know where to start. Elaine, you're confusing me. This is too much, right? Start with maybe going through a bond, buying into a bond mutual fund. And then you can start monitoring that activity before you start making your own individual bond investments. Then there's bond ETFs. So similar to mutual funds, but they are traded like stocks. So bond ETFs give you liquidity, and liquidity is being able to relatively quickly get your money back. And it also provides you with diversification. So remember when we talked about a bond typically has a maturity date. And let's say that maturity date, just for conversation's sake, is 5 years. You cannot get your principal, that $1,000 that you put in, you cannot get that back for 5 years. There's very rare circumstances, if any, that the issuer of that bond will allow you to get that money back. However, if you invest in bond ETFs, you can buy and sell them very similar to a stock, right? And that's what we're talking about, liquidity, that you can get your cash out. So if you have an emergency situation or you might need this cash within like the next 12 months, doing bond ETFs might be a good option for you. So once again, bond ETFs are very similar to mutual funds, but they're traded like stocks. Bond ETFs really give you that liquidity, but also the benefit of diversification. They track bond indices and provide exposure to different types of bonds, such as government, corporate, or municipal bond. They might even include social impact bonds. They might also include pay for success bonds, right? But whether you choose to buy individual bonds through a broker or invest in a bond fund and ETFs, each method offers a way to benefit from bond investing while aligning with your investment style and goals. So, just to recap, right? You can open, if you are looking to buy bonds, you can buy it through a brokerage account by setting up your own brokerage account. You can go on to using bond fund or ETFs, but also, I want to keep iterating. There are professionals that can help you do this. You can get a financial wealth advisor, a certified financial planner can help you, walk you through. That is their job, is to help walk you through having these kinds of conversations, right? They're going to ask you, what is your goal? Or do you have any big ticket items that you're needing to plan for? Are you planning for retirement? Are you planning for children? Are you planning for an investment property that you're looking to buy? Working with a professional is going to ask you all of these questions that are going to get you to build a portfolio that worked for you. So you might be wondering, how do they get paid? The way that they typically get paid is, and there's a variety of different ways, and you need to ask that question. You'd be surprised how many people don't ask that question when they get a wealth advisor. I work with wealthy people who've never asked their wealth advisor how they get paid, but that's an aside. We won't go down that rabbit hole. But the way that your wealth advisor typically will get paid is in one in a few ways. One, they might get paid off of commission, meaning that the things that they are asking you to invest in or they're promoting for you to invest in, they're going to receive a commission off of, right? Some people get paid a flat rate, and that flat rate will fluctuate depending on how much of your money they're managing. Some people get paid off of a percentage of your investment. So they may have a threshold of under $500,000, it's 2%. If it's $1 million to $10 million, it's 1.5%. And anything over $1 million might be 1% or 0.5% or 0.75%, right? So there's different ways of how a wealth advisor will get paid. So you definitely want to ask them, how are you paid? You definitely want to be conscientious of the fact that if a wealth advisor is getting paid on commission, that what they're presenting to you, there may be implicit, while they do have what's called a fiduciary responsibility, right? Fiduciary responsibility is a big fancy word for saying they have an obligation to you to take care of your money. But it's hard to delineate that if you're getting an incentive, that doesn't weigh into what you're providing me, right? Or what you're sharing with me as far as opportunities go. So just keep that in mind. I'm sure wealth advisors have every best intention, but at the same time, we are all human. So once again, don't be afraid to ask questions. Ask if you don't know, ask. If you need to understand, keep asking the question. Ask them to make it, draw it in crayon for you. That is their job. That percentage that you're paying them, that's what you're paying them for, is to help you and answer your questions, right? So here are some more tips around investing, doing bond investing. So now that we've really talked about how to buy bonds, now let's talk about some practical tips on to get you started and making really good informed decisions. So the first tip, and we talked about this at the top of the show, doing your research, research. Unless you're going to have an advisor, and even if you're going to have an advisor, I encourage everybody to take an active role in their investments, even with a wealth advisor. Asking your wealth advisor, what is in my portfolio? And going and doing some research on the companies that are in your portfolio, particularly if you're looking to have a values aligned portfolio. If you really want an investment portfolio that's aligned with your values, and we talked about that in the first couple of episodes of the show. Are you involved? Are you investing in things that are against your values? So I'll give you an example. I sit on a few boards of directors of a couple of philanthropic organizations, and we've recently gone through creating an investment policy statement. So how do we want to invest the money? We have one of the organizations. It's over $100 million that we have to for philanthropic giving, and so how do we want to invest that money? The organization has some deep religious roots, and so one of the things that came up that as we were putting together this investment statement is like, what will we do if there's a conflict between our religious values and the investments that we're looking at, right? How will we navigate those decisions, right? But once again, that requires for us to have some line of sight into what's in our portfolio. Now, you don't always have the benefit. So going back to these bond ETFs, they are going to be a collection of bonds. You may not be able to research every single one of them, right? You may not even have line of sight on some of them, right? When you buy into a portfolio of whether it's stocks or portfolio of bonds, or even sometimes your 401k, you don't necessarily have access to that level of detail. And that's okay. The most important thing is that you're asking the question, right? What's in my portfolio? And just know that you won't always have line of sight to the line detail of what all the stocks are or what all the bonds are. But in some cases you are. So even if you just took a random sampling, if you were able to get a list, invested in a bond, or you're invested in a stock portfolio, or a fund that has a group of bonds, then you can say, if you can get that list, let's say it's 50, just do a spot check. Take like 3 or 4, look at the companies. Where are they? What do they do? Are they socially and have an environmentally, and is their governance structure such that it aligns with your values? Maybe you don't care about those things. Maybe you do care about those things. If you do, taking sort of this random pull of what's in the portfolio to be like, I'm going to pull 3 companies and I'm going to do some research on these 3 companies. Okay. Once again, the point of this is not for you to go down some deep, dark matrix rabbit hole. The whole idea is that you are actively engaged in understanding what's happening with your money, where's your money going to, and how is it being leveraged. Let's say, for instance, you do not want to be invested in guns or private prisons. Knowing whether or not private prisons is in your portfolio will help you to knowing that will say, oh, I don't want to be invested in this, which means you're not contributing to the perpetuation of that particular activity. So these are all the things that when you're thinking about research, how you can start to think about how you can approach the research without really going into this deep, dark Alice in Wonderland rabbit hole. But keeping it, you want to stay, I like to say, you don't want to stay at the 10,000 foot level, and you may not want to be at the 5,000 foot level. Maybe stay at the 7,500 foot level. Once again, really spot checking things, for asking questions, going on the internet, seeing what information is available about the company or about the fund. What my favorite thing to do is, like, I'll put into Google bad things said about this fund, right? Bad things said about this company, because that's what's going to give you the information, as opposed to a general search. This is going to give you a list of what's available. Really thinking about, I want to know what's the bad stuff, and then looking through that and making my own evaluation, right? So once again, let's go over the tips. So tip one, research and understanding the issuer's credit rating, meaning the organization that's issuing the bond, what's their credit rating? Always check the rating on the bond issuer before investing. And once again, you can do that through organizations like Moody's or Standards and Poor's, and you can find their credit worthiness. Look at the bond's credit rating, whether it's AAA, AA, to reduce your risk or default. And remember, lower rated bonds offer higher yields, but can come with higher risk. The next tip is consider bond duration and how it aligns with your investment goals. Bond duration refers to the length of time until the bond matures. Short-term bonds mature in 1 to 3 years, medium-term bonds are 4 to 10, and long-term bonds are 10 plus years. So choosing your bond that matches your investment timeline. If you need funds in the future, short-term bonds may be more appropriate, whereas long-term bonds, if you have long-term goals, consider longer, medium, and longer-term bonds. And then my last tip is stay aware of interest rate trends and how they affect bond prices. Interest rates and bond prices have an inverse relationship. So when interest rates are high, bond prices fall, and vice versa. This can impact the market value of your bonds. So here's an action step. Monitor the interest rates trends and consider how the changes might affect your bond investments. Once again, the investment simulators that I told you about in the previous episode are really great to just start your learning journey and seeing what you see in the market is going to impact your portfolio without really losing any money. But following these tips, you can stay really informed and build a robust bond portfolio that aligns with your goals. Once again, here's another resource. The Bond Market Association offers really great resources and education for new bond investors. This is a great place to start if you want to learn more about the bond market and how to make the most of your investments. Just visit their website to get some more materials. Now it's your turn. Take the first step by researching just a couple of different types of bonds and considering how they might fit into your investment strategy or your goals. Remember, bonds can be a valuable part of your financial plan, and they can provide you both income and stability. I hope that you have found these tips and resources helpful and that you're feeling inspired to take more control of your financial future. So happy investing. That's it for today's episode on bonds on the Do.Different.Better Show. I'm your host, Elaine Rasmussen. So today I broke down what bonds are, how they work, and the different types you can invest in, from government bonds to corporate bonds. And we talked about some new kinds of bonds like pay for success and social impact bonds. I shared how bonds can provide steady income, preserve your capital, and diversify your income portfolio or your investment portfolio. I also compared bonds to stocks and explained why bonds might be a little bit safer haven during market volatility. And then lastly, I walked you through the process of actually buying bonds and gave you some practical tips and resources. I cannot wait for next week's conversation. Join me in the next episode of Do Different Better when we continue your wealth education journey. I will see you next week. Let me know what you think of the show. We love comments. So tell us how this show has helped you. And if there's a money or finance question you have, or if there's someone you want me to interview, hit me up on LinkedIn or Instagram. Don't forget to hit the subscribe button and follow us on their socials. And I will see you next week when I show you how to do different better. See you next time.